And so here we are again for Dollars and Making Sense for the week commencing 9 December. Welcome again, Henry Jennings.
Hi, Ray.
Wonderful to see the moustache is gone for a second week in a row. We had some wonderful comments on the web to see the caterpillar had departed. So again, all for a good cause, but man, it was still in bad taste.
It was.
Not to worry. No. And again, during this the course of today's discussion, we're going to be looking at what was, in fact, rather a horrible week on the markets. And again, for those of you that are regular watchers, we really appreciate your loyalty in such an early stage of the program. This, however, will be the last program for the year that Henry and I will be doing. However, tomorrow night, because today we always record on the Monday, broadcast on the Tuesday morning. The YouTube goes out Monday night. But tomorrow night at the Chatswood Club, we'll be participating in a panel discussion with Ashley Brown and the folks at the Australian Investors Association from 7:30 p.m. They have their yearly quiz. And then we'll be getting stuck into a bit of a panel discussion about the year that was and the year that's going to be coming on in 2020. And along the way, we'll actually be recording tomorrow night's proceedings and turning that into our regular broadcast for next week for Dollars and Making Sense for the YouTube channel and also for the radio show and our podcast. So, Henry, the week that was, what happened?
It was a shocking week. It was a week, I guess, that was punctuated by, once again, the volatile nature of Donald Trump, his tweets. It started off with a pretty grumpy Trump at the NATO summit, and it just sort of went from bad for worse to the markets. I guess that the key to the falls we saw on Tuesday and Wednesday were basically to do with Trump saying that he may not even sign a deal until after the election. And the market had really got itself into a very optimistic phase about how the deal was going to be signed, or some sort of trade deal, phase 1 light, or whatever you want to call it, before December the 15th, because that's the next deadline when the tariffs increase on a lot more consumer goods. So that feeling that the US was in no hurry to really sign any kind of deal or do a deal with China really upset the markets. And we saw, I think Tuesday was 105 points, and then we had 150 points as well. So we knocked 250 odd points off the index in 2 days before we did see some more stability and a rally coming back as US officials kind of walked it back and said, you know what, things are still on track for some sort of deal. So we did bounce back, but we're still down for the week, and it really was, I guess, a week of AGMs and a week of that complacency that we'd seen in the market about a trade deal sort of we were awoken from a slumber.
Do you get the feeling, though, that, again, you've said on many occasions that Trump's no fool, that this is really a political play more than anything, that the impeachment hearings and the like is generating a lot of noise, and his ability to be able to hold up trade talks and impact that much on the indices really does, play him as a very important player, regardless of what people may personally think about him.
Yeah, I mean, I think at the end of the day, what Trump is trying to do, whether you love him or hate him, in reflection in against China, is actually long overdue. The Chinese have enjoyed a World Trade Organization status that does not befit the size of their economy now. When they first joined the WTO back in the early 2000s, then they certainly were an emerging economy. Now they are the second biggest economy in the world, and they do enjoy some WTO status privileges because of that. So this trade war has been a long time coming. So he's right to pursue this. The problem that both sides have is that it does look suspiciously like both economies have stabilized at these lower levels. Now, whether that just means that the next ratcheting up of trade tariffs that happens on the 15th sort of kick it down again. But we saw some jobs numbers out on Friday from the US, which absolutely knocked the lights out. The market was going for around 180,000 jobs from the non-farm payrolls number, came in at 266,000. Wow. Unemployment at a 50-year low, wage increases are not quite as good as expected, but certainly that US economy is ticking along pretty well. Consumer confidence is still pretty good. Black Friday sales were very good. Cyber Monday sales are very good. So the US economy is going pretty well in this tariff environment. Equally, the Chinese economy seems to have bottomed and is showing signs of life. So the imperative for both parties now to do a trade deal is not as great because both of them could claim they're doing okay. So we have to be careful that this complacency to doing any kind of deal slips in. I suspect we're going to get a rollback of the December 15th tariffs, some limited purchases of agricultural products from the Chinese, and the market will just have to get used to the fact that we're going to be playing this game for a while.
So with that happening as the main game, we still see Australia as a sideshow because we're a tiny fraction of these behemoths out there. And again, we had the Treasurer coming out this week, the past week now, talking about everything's fine and plain sailing. But I'm reading far too much that suggests otherwise. Was that reflected in the markets here of the All Ords and stocks?
I guess to some extent, yeah. I mean, we did take a cue. We had some pretty good trade numbers as well last week. But again, it's just showing
2 quarters running for trade surplus.
Yep. So that's
first time for a long time.
First time for a long time. But it does just highlight the importance of iron ore and coal, which is not a great situation for an economy because it's kind of hollowing out the rest of it. And this is certainly something that happened when the Aussie dollar was $1.10. So I don't think anyone's really listening to our local politicians, to be quite honest, at the moment. We've had a lot of AGM noise in the last few weeks, earnings upgrades and downgrades, and the song remains the same. And it's very much dictated to by the US and China. Canberra is and has been and will continue to be sideshow alley. It's really not the
policy-free zone.
Well, there's nothing going on there. There's nothing that is possibly market influencing. The only thing that's happening is the RBA talking about interest rates, but even that has limited appeal now for the market. We're just really, Canberra has become so irrelevant to the economic growth at the moment because there's no policies about economic growth that the market really has to run on its own fumes.
Spectators, who knows? Who knows? We'll come back to Mr. Frydenberg and some of the analysts that have taken apart what he was talking about last week. Again, viewers and listeners, I'm going to harp back to a company that we talked about a number of weeks ago that ended up in this week's world's largest IPO ever, being Aramco. Henry, it finally got done.
Yeah, it did finally get done. It hasn't listed yet, so it's we don't actually know how it's...
But the price has been set.
The price has been set at 32 rials. It will list in Saudi Arabia towards Christmas time. They raised $25.6 billion US.
Yes.
And they sold 1.5% of the company.
They really lashed out there.
They really lashed out. Value of the company at around 1.7 trillion. Luckily for them, it also coincided with an OPEC meeting where they managed to talk production cuts greater than the market was hoping for. So it's really helped the oil price, which of course is the reason that Saudi Aramco exists.
That's their raison d'etre, yes.
It is. So, I think there's probably few Western funds that got really involved in this. I would imagine that Saudi has pulled some serious favours from its neighbours, and there's a lot of Gulf UAE funds that have invested in this thing, and a lot of retail investors from Saudi Arabia have invested in this thing. I would be surprised to see too many Western funds would have looked at this at all, because the transparency of the company is so small, is so bad, and the actual float at 1.5%, even though it's a big number, the liquidity, who knows what it's going to be. So I suspect a lot of people will hang back, and there's no reason to own it. There's no reason to buy another oil company in a market which is relying less and less on oil.
Again, when you value a company at 1.7 trillion and you bring in $25.5 billion of investor cash, I'm just curious. Now I throw the question back at you. What do you do with the money? What are they going to do with those funds?
Saudi, but they're basically going to buy the goodwill of their people. That's what they do. They build roads, they give back, they give free education, all these sorts of things. And it basically provides a very high living standard for the Saudi Arabian citizens, because at the end of the day, the House of Saud, which is in power in Saudi Arabia, is there because nobody will overthrow them. So if you have a very, if we had a situation like Hong Kong, where the ruling government party, whatever it is, was unpopular, there would be a chance of overthrow. So the House of Saud has to keep their citizenship happy, and this is part of dragging Saudi Arabia into the 21st century, reducing their reliance on oil, ironically, and investing outside of the oil market and getting a better standard of living for their citizens.
Gives quite a specific definition when you talk about sandpits that I come from in the IT world. When we talk about sandpits and development, Saudi Arabia, if you're investing there, you really are investing in a sandpit, aren't you?
Yeah.
Okay, and I keep looking through your Friday missive from Beaks Down Under. Again, an interesting one I picked up on, the speculative stock of the day, Tyro Payments.
Yes.
Tell me a little bit about these guys.
If you're a small business owner or even a big business owner, you probably have come across Tyro Payments. These are the guys that manage the point of sale FPOS machines. They have business lending, business banking embedded in their technology, so that they're a payment processor to some extent. And these guys listed, they had an IPO which listed, and it was a very successful IPO. It was up around 25-26%
Yeah, I saw.
on the first day, and it was actually it turned out to be the biggest IPO of the year from an Australian company, which is good. Latitude Financial was trying to get in before them a month or so ago, and they failed for the third time to really get that IPO off the ground. So this was a really good kind of vote of confidence in the fintech sector. They're the fifth biggest sort of payment solution provider for Australian business, and it looks like they've built on that rise on Friday, that first day of trade. They've built on that rise with another 2 or 3% gain today. So that's a good sign that there's that confidence in the IPO market and demand afterwards.
But the fintech industry here locally, although it's still nascent, is doing rather well, isn't it?
Yes, it is. It is kind of a derivative of the banking sector, because a lot of the fintechs here, their funding, their wholesale funding, comes from the major banks. So stocks like Zip and even Afterpay and all these guys that are out there at the edge of the universe to some extent, they get most of their funding from big banks who are just basically outsourcing their technology and finding another way to distribute money through another channel. But the fintechs certainly are doing well here. Commonwealth Bank has always been very good at the fintech side of things. We've seen obviously NAB and Westpac and ANZ, especially Westpac, haven't been so good at the fintech side of things. But there are a number of success stories here, which is heartening. But I'm sure, if you looked at everybody else's economy and their market, there'd be a lot of success stories in this space because it is opening up.
But again, I simply remark on those, Henry, because we still are a country that so heavily relies on digging stuff out of the ground or the four pillars. I guess from an investing perspective, it is nice to see a good news story about a technology company. We've had a few in the past, and again, even if they are small, and the fact that we focus on small to medium caps, these are emerging companies that I think I want our listeners out there to be considering people outside of those top 10 stocks, because not just from a diversification perspective, but we spoke a number of weeks back about double, triple, or even 10 or 100 bangers. These are the ones that potentially can give you a modest return or even potentially a massive return.
They can. You clearly have to risk adjust in terms of how much money you put into these sorts of things, because you don't want to be putting in your whole entire
absolutely
portfolio.
not. The eggs in one basket still maintains no matter what you invest in.
But certainly, it does give you a tail. That gives you a bit of a kicker in that tail. So there are a lot of stocks out there that can do that, and fintech certainly is one of them. It would be nice if we had some tech stocks that actually didn't just count people's money and their superannuation, which has become such a behemoth of the Australian landscape now that it wins and loses elections effectively.
Doesn't it ever? And a special reach out to one of our commenters of YouTube about our dad jokes. Again, this one I attribute to Henry. What do you call security guards working outside Samsung shops? Our producer behind the camera might know this one, but Guardians of the Galaxy. I thought that was very tongue-in-cheek. Very good. Thanks for that, Henry. That's Henry's fault, not mine, by the way.
Sorry.
Now, previously we'd mentioned EML payments, and again, it got another mention in the press. during the course of the week, in the trade press. But they also mentioned a couple of others, Henry, that you may or may know about: Imdex and Efergex Energy.
Yeah, Imdex has been around for a long time. Drilling mud is one of the things. They're a mining services company, and they do mud technology, and they also do the way to drill directional drilling. So if you're drilling an oil well, you can go down, and then you can start following the oil with some of their technology. They had a rather colourful character who was in charge for a long time. But they have done quite well. Mining services clearly is one of those businesses which is very leveraged to commodity prices.
But it's the picks and shovels of the old days, right?
Picks and shovels.
Picks and shovels.
And the picks and shovels guys can do very well. They can also do very badly because mining companies, they're not as profligate with their money as they used to be. They tend to be
back in the boom days, yeah.
Back in the boom days, they just chuck money at Monadelphous and all these guys out there to build, expand, and contract to produce. But nowadays they're far more circumspect, and the costs have been a serious focus for mining companies throughout the world. So Imdex has been an interesting one over the years, and it certainly has been it has been a relatively good performer. So I know there's some people that like it, but yeah, it's I guess there's a couple of stocks in that space that are geared to the oil price. One is Worley Parsons, which is a mining services company involved in oil, and Imdex is the other one.
So Imdex is the ticker is IMD, and Warlex, what's their ticker?
Worley Parsons, WOR.
WOR.
Yeah.
Okay, we'll just keep a watchful eye on those and again, given that we spoke about EML, and again to refresh your memory from last week, ladies and gents, these were the people that specialise in digital gift cards and prepaid cards, leveraging that technology platform in gaming and wagering. And again, if anybody ever doubts the power of the gaming and wagering industry, particularly in this country and say the United Kingdom's, not the US, but even the US.
I think the US is massive.
When off the top of my head, my wife and I just tried to count the number of gambling companies, and we rarely watch commercial telly, mind you, and we could rattle off 8 to 10 of them without thinking too hard. Well, again, Bet365 is in the news this week because they actually don't pay their winners.
Right.
If you start winning too much with Bet365, the ABC allege that they start ratcheting down the number of wins, and you become a problem customer.
Right.
that's when the PC terminology in Bet365 becomes a real issue, because they report this one particular gentleman who is an ex-employee as well. So he's been on the inside, and he spilled the beans quite horrendously against Bet365. And there are a number of stories that have come out this week. There's Paddy's, the owner of that, now lamenting some things that he regrets while he sits on his billions, I guess. And the OBE winner of, I think it's, what was her name? But she was the originator of Bet365. And again, this whole premise around the world is where they will simply get rid of their PCs, their problem customers, and send them to other sites. And if you're comfortable, if you're a bettor, good luck to you. I'm not, but I have a lot of trouble with the ethics and the morals of people that brazenly do this, but it's a free market and people can go wherever they like.
I must admit, I did have a sneaky bet this morning on the UK election, so I couldn't resist myself.
What, on Ladbrokes, on a betting site?
On Sportsbet, which I have an account with, and I tend to only use it for politics and major sporting events like the World Cup. Are you going
to tell the viewers what you bet on?
Yeah, I did. I backed the Conservative minority government.
So Boris
still,
and then having to horse trade,
and I got $17 for that, 17 to 1, which is a lot better than the odds on Boris winning an outright majority of $1.64. So for me, that did seem a pretty
$1.64.
$1.64.
That's pretty short odds.
Odds on get on with the polls are certainly pointing to a Boris victory, but polls are wrong.
They've been notoriously wrong for the last 4 years.
They have been notoriously wrong, and the UK has a different voting system to Australia. We have a first past the post system, so you can get 99% of all the votes in one electorate, and win, but that's still only one seat. It doesn't actually have any proportional representation or anything like that. So $17, I thought that was value.
Well, we'll wait and see.
We'll wait and see.
It's disclaimer time.
Thanks for listening to Dollars and Making Sense, a weekly program about finance, money and investing. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. And if in doubt, you should contact an authorised licensed financial planner.
Again, one of those interesting things about financial advice too, Henry, I think 2020 is going to be a watershed year for the advice industry. Having been a licensed financial planner myself and no longer, I've taken the reins of my own investment trust. The industry is going through massive restructuring. The accreditation scenarios are making it increasingly difficult. The costs to stay in the industry, I think, are going to be the subject of a lot of discussion next year. And given that the vast majority of the financial planning industry, in my view, certainly are right-leaning coalition-style voters, I don't think there are too many happy out there with the financial services legislation and the regulations as they're going at this point in time. And it also points back to, Henry, what we spoke about, the 23 million transgressions by Westpac and the expectations of organisations to be able to not only service these transactions, but know the intent and purpose and raison d'etre why people are necessarily doing their $9,999 transactions. And financial planning is no different, ladies and gents. And I can tell you, given that insurance premiums in my space have trebled in the last year, that's going to start flowing through to the industry sooner or later. But more on that in 2020 anyway. Henry, I'm going to move on now to an interesting piece that your boss, Marcus Padley, put out during the week. And it was posted on Livewire. And again, I follow Livewire because I always find a lot of very good market commentary and also some interesting things to pick up and have a discussion. Now, Marcus has never been shy to say his mind, has he?
No, I think that goes for the whole Marcus Today team, to be honest.
And that's why we welcome your inputs. It's nice not to have sugarcoating. And again, we're going to get onto a couple of other commentators during today's broadcast. One in particular that I like is Greg Jericho out of The Guardian, and Stephen Koukoulas also.
The Kouk's always good.
The Kouk, to me, is one of the few economists that plays it very straight. And having got to know and meet Mark Thirlwell at the AICD, even being part of an incredibly conservative organisation, Mark calls it as he sees it. And we'll be covering that off in just a little bit. Anyway, back to Marcus. Marcus is talking about in his piece, and it's quite a lengthy piece. Gosh, by the time I printed it out without the graphs, it was quite a long read. But Marcus is simply going back to all of the investors and saying, guys, it's not that banks are necessarily bad, but we've had so much of a focus over the last 15, 20 odd years around banks, and because they do have these franking credits, have we missed out on other investing opportunities?
Well, of course, the answer is most definitely yes. But part of the reason why banks are so popular is not necessarily because the investor likes the banks, but this goes back to your point previously, it's the actual advisor likes the banks. You're not going to blow somebody up in Westpac or National Bank or CBA or ANZ. They might not perform very well, but they're not going to go bust. So it's very hard as an advisor. You've got to do your best as in terms of the advice, but you will gyrate towards solid, proven investments that have a good yield with limited risk and that offer tax efficient benefits, which is why every fund is stuffed full of banks, and they might have all four banks,
that's diversity,
which seems a little crackers, but anyway, that's how it works. But certainly they have been, if you go to any kind of private client advisor or financial advisor, they will, first thing, if someone says, so where do I put some money? So you've got to buy some banks because you need that yield. And that's what people do. There are other ways of getting that yield, and a lot of people don't actually care ultimately about the capital appreciation, whether it's a loss or a gain. it's all about the yield. So as long as they've invested their $100 and they're getting their 5.5% fully franked yield, they don't care whether that $100 is worth $80 or $120. $120, they're not going to sell it. They're just going to create a tax problem. $80, it's somebody else's problem. It's the kid's problem when they die.
As Marcus points out.
So, really and truly, as long as the company continues to pay the effective coupon, the dividend, all is fine and dandy, and that's all they're concerned about. So what Marcus was writing about was that there is certainly an investment case that suggests that you shouldn't be just looking at the dividend, you should be looking at the total return, which is a total of not just the dividend but also the capital appreciation. Of course, if you're looking at the capital appreciation as part of your income, then that does have some tax implications, and it means that when you want to go down the shops or you want to go on that cruise to Hawaii or whatever, you are going to have to sell some shares to afford that because your income is not covering those expenses.
Right.
So you are selling shares all along, and eventually, I guess, you will run out of shares to sell. And as you sell shares, your income diminishes, and
it's eating your babies.
It's a catch-22. The trick is to time your exit on two fronts, both by your mortality and also by selling the last pack of the last tranche of shares on your deathbed, which of course doesn't leave much for your family.
Well, again, I guess with most of us, at our age now, the average dying age is 83/84 for male, female.
Doesn't feel that far away now.
Well, by the time we get there, it will have increased at least another 2 to 3 years.
Yeah.
So that's the average. And so it's a long time to have to self-sustain. And Marcus simply makes the point. Again, listeners, all I'm simply saying is, keep buying into banks. I'm certainly not saying don't. I'm simply saying look further afield to give yourself a little bit more comfort. And Marcus makes the point in here. If you're going to take the risk in equities, and I'm quoting from this article, you'd be far better to focus on total return than just dividend yield. Okay, and he suggests, and I certainly support him in this, that it distracts retirees from necessarily getting the best stocks in the market. So, keep investing in banks, but I think what this is simply saying is look further afield. And he points at things like CSL, Aristocrat, Cochlear, Treasury Wine Estates, and the list just goes on. And he's simply making the point that, especially in the last 5 years, when you compare the performance, they've done very poorly in comparison to the remainder of the market.
I had $100 chuck way back. I think it was September 2013.
What's a $100 chuck for those that aren't familiar?
So the $100 chuck was basically you could buy what you could buy for $100,
right?
And you could buy the 4 banks for $100. So you buy 4 banks, $100. You could also buy the BHP and Rio and Fortescue.
Fortescue's on my list for today, yes.
For $100.
Yep.
And it's been interesting to track that over the course of the last 6 years. And I think at the peak, the banks got to the $100 chuck was $216 worth. This was no dividends included. This was not reinvesting. This is just purely you just add up the share prices of the big 4 banks. Just really simple stuff. And it got to 215. It's currently around 104, 148, 150. It's recently been up to 165, 170. 147 is the kind of area where it tends to bounce from, funnily enough, over time. But it's interesting to look at it. If you put that $100 into the banks back in September 2013, I think it was, it'd be now worth 150, say. So you're up 50%. That's not including your dividends. The same basket for the resource basket, which is the BHP, the Rio, and the Fortescue, would be around $134 with no dividends included. So, and that was underperforming for a long, long time. It's only recently actually started to creep back up. But it's interesting to see what you can get for $100. The $100 chuck was actually a thing back in the 90s. There was we did one when I was working for Macquarie, and Commonwealth Bank did one as well, which was basically you could buy the $100 basket and it gave you the 10 litres with 10% in each, and it was the top 10, and it was packaged up as a product.
Fair enough. It's easy to digest and easy to understand.
It was if you're starting out investor and you're looking to invest in something, and this was before ETFs. So this was just basically giving you
a precursor to
exposure. Yeah, I mean, we all dreamt up lots of esoteric products in the 90s that actually became ETFs.
So for those that are interested, maybe go to your search engine of choice and just put in Marcus Padley and Livewire. Again, I just simply highlight, his closing comment. You're giving up potential returns, to get a dividend. Sometimes it's good just to let the company keep their dividends and reinvest it, because that return on their investments actually can deliver far better gains. But again, it's simply to consider. And there were plenty of other people, including, again, I picked up a piece from Joanna Nash at Acadian, who was also talking about the fact, look, the bank dividends aren't fabulous at this point in time, but it's still holding up pretty strongly when you compare it to bond yields and a range of other potentials out there.
I'm not sure where else you get 6.5%-7% fully franked yields.
Correct. Anyway, we keep going on. During the course of the week that's just been, we've had a couple of politicians stand up in front of the press and tell us all that everything's going rosy and don't worry, it's all fine because the coalition is in charge of the economy. I followed Greg Jericho quite a lot and Steve Koukalis, and Greg this week has put out a very interesting article around, at what point can we say a plan has failed? And we alluded to this early in today's broadcast when we talk about, a government that is spectating. They're just, watching the water drift past. And this particular article talks about, some of the worst quarters we've had since this fabulous run of almost 30 years. Three of them, out of the, and they were talking about the economy is improved, but the quarters are, going down at, I think, 1.7 or 1.6%. There've only been 9 of these since 1991. Out of those, though, 3 of them have occurred this year. And so, when you're looking at these numbers, one of the things that Jericho goes on to talk about is household consumption. Makes up nearly 60% of the economy, yet it barely grew. And the same numbers that have come from him, as well as being picked up by Mark Thurwell at the AICD, dwelling approvals fell 8.1% in October and are down a whopping 24% for the year. So whilst a government may sit there and say everything's fine and dandy, the household budget doesn't believe so, and retail spending in many indicators right now aren't looking that rosy either.
No. Well, having said that, when you looked at the Black Friday sales and the Cyber Monday sales were extraordinary, records. Jerry Harvey was grinning from ear to ear, which is unlike Jerry Harvey, but they were extraordinary. So I don't think there's actually per se a massive problem with the economy that couldn't be solved by a little bit of optimism and a little bit of leadership. Unfortunately, we don't have either of that at the moment, and we do have a media that seems to be convinced to browbeat us into submission through negativity. But the actual, when you look around, the money that's still around, and there's still a relatively good jobs market. New car sales have fallen off a bit of a cliff recently, but a lot of people are driving. We're selling 1 million new cars a year, which in a population of 25 million, to me, that does seem quite a lot. That does seem like every man and his dog is just about got a new car. So I find that, when you drive around the streets of Sydney, the car fleet of Australia is pretty impressive. It's worth quite a lot of money, and it does not look as if people are doing it that tough. The number of new, Ford Ranger tradie specials and Hiluxes, etc., is still pretty good. So I think, the economy is certainly in a funk, but I'm not sure if that's because we've talked ourselves into that funk, and now we're starting to see at least some green shoots with the wealth effect from higher property prices helping us. And maybe the last 2 years of austerity, which maybe that's what we've been through. Maybe we've been through the austerity that some of the Europeans have been through. We're starting to see some signs that maybe people are going to get a little bit more optimistic. I've got to say, it doesn't show up in the official numbers yet, but when you talk to your friends, they're not doing too badly.
Well, I'll remain and beg to differ. And
Got to have the right friends.
Well,
Clearly.
I guess we'll wait and see. I mean, we're at odds right now with regards to interest rates, because I certainly believe they will go down one more time between now and Easter. And I'm now not alone in that. I've heard a couple of other commentators now joining in, simply because these numbers that are coming out in the last week or so, combined with household expenditure flatlining, I think, again, it's simply going to be a case of something needing to be done. We'll wait and see. I just don't, right now, I have a healthy level of skepticism towards the mainstream media and this notion that everything's fine when it certainly doesn't feel so.
Well, I think the economy has fundamentally changed because, from a young person's point of view, it's a really hard thing out there at the moment. I've got two youngish kids, 2 young adults, and it's not easy. Rent is extraordinarily high. Even if they've got a good job, they've got high student debt. They've got that hangover. Going out is massively expensive. And these are the consumers. These are the guys that are going to come through and actually consume. And clearly, they don't consume the same way that we consume, or we did consume in our 20s. They've got far more myriad of options like Afterpay and these sorts of things. Also, they want to go travelling. They save, they go travelling, etc. So the economy, I think, is changing because the demographics are changing. But certainly, around this part of the world, cafes are full every day, restaurants are full on a Friday night, cars are new, utes are new, there's no shortage of work. You try and get a plumber, you'll pay $200 an hour, etc. It's there are certainly reasons to be cheerful, as Ian Jury would say.
Part 3.
Part 3.
Okay. Now, picking up on somebody we spoke about a little while back, it was probably only 2 or 3 weeks, Mayfair 101. Now, these guys caught my eye because I've been copying quite a lot of their electronic direct mails saying, welcome all wholesale investors, let's give you this kind of yield and we'll lock your money up for a certain number of years and we're going to go off and do some really cool and interesting things with it. Well, it turns out those cool and interesting things was going and investing in Dunk Island. And just yesterday, Ben Smee from The Guardian put out another update of Marwini and Co. and their forays into Mission Beach. Fascinating. Henry, before we came on air, I was asking you about this. You read this article as well. What's your view on it?
I did read this article. I mean, it's if you get past the glitz and the glamour and the marketing dollar, so clearly they're spending a lot of money on marketing of this fund, and they're basically raising money from people to buy into properties into Mission Beach and into Dunk Island, which then, in theory, because you've got Mission Beach as well, you're kind of taking away some of the risk. And they trying to buy everything pretty much in Mission Beach.
Well, that's what this article suggests.
By the article, they basically just went, I'll take everything, thanks very much. It's the Victor Kiam, it was so good I bought the company. So that they've certainly got designs on this. There does seem to be some issues surfacing, and clearly there are some locals suspicious of the man from Melbourne in the shiny suit coming and saying we're from the government and we're here to help, or we're from Mayfair 101 and we're here to buy your property. So clearly there are some issues around conservation, the environment, what it's going to do to the whole vibe of the place. But some locals are grabbing it with both hands and saying thank you.
Take the money and run.
Take the money and run. We'll go and move somewhere that we're not going to get hit by a cyclone. But it's an interesting business model, which there's a lot of glitz and glamour around this, and people you can fool some of the people some of the time, but I'm not sure you can fool all the people all the time. It certainly wouldn't be something that I would be putting my money in terms of locking into Mission Beach property.
And again, I'll declare my conflict of interest. I run an investment trust, so it's a fixed income and potentially a competitor to something like Mayfair 101. But I have real issues with anybody that will spruik 10,000 job increase in the same area, which means a trebling of a local population base in a very environmentally sensitive area. We've talked about cyclone proofing, or whether you can or can't, and the vagaries of a tourist-led recovery in any area, given that if we have a reliance on overseas people coming in, and we've seen the demise of casinos that keep on wanting overseas high rollers to come in and fund these great expansions. I simply continue to say to people, when it comes to Mayfair 101, and I'm not the only one here, okay? I've been to these kind of marketing glitzy events. My skin crawls, okay? And look, I've never met James Mawhinney. I don't know these people from a bar of soap. But just reading this on its bare surface, it makes me want to run for the hills, quite frankly.
I think we've all met James Mawhinney. I think we all know him. He just goes by a different name in different cycles.
I'll leave it at that. And to close out this week, and we'll keep tracking this. And again, I'm not going to hold it up too high because last week I spun my producer out by trying to get this in focus. My apologies, Mitch. Our dollars making sense portfolio has been a bit of a rocky ride this week, I must say.
Yeah, no, it's never going to be good when you own leaders and the market goes down 2% in a week. So let's face it. We are This is actually a crucial week, not just for this portfolio, but for a lot of people's portfolios.
Oh, you bet.
We've got a UK election, we've got an RBA governor speech tomorrow night, but more importantly, we've got December the 15th on Monday, and that will set the tone. If we get some optimism from this week, a solution to the Brexit issue and a solution to phase one of the trade deal, then we can fire up the sleigh and start saying ho ho ho, Prancer, Dancer, and Cupid and Donner and Blitzen and Comet, and Rudolph, of course, will be pretty happy little reindeer, and they will start the what we could call the Santa rally, the Santa Claus rally, and that could take us through to fresh all-time highs, and maybe January the 26th, the Australia Day holiday is kind of the moment when the market comes back and is serious again. So we're starting to go in the silly season now. If we get some optimism, the silly season could push us back to that all-time high.
Okay, so with that in mind, we'll keep these up on the blog. And just a reminder, this is our last YouTube from this studio that we're doing for the year. As I said, tomorrow night we'll be recording the panel discussion at the Australian Investors Association, and we'll be posting that in edited form. And then from then on, we'll probably be taking a bit of a break right through to just after Australia Day. In fact, we'll pick up the gauntlet again and start jousting and seeing what is worth waxing lyrical about week by week. So from us at Dollars and Making Sense, we'll sign off for this week, commencing the 9th of December. Thanks so kindly for watching during the course of this year. We've launched in early October, and again, we've built a small but rather loyal audience. We appreciate that. And again, through my own resources, we did a bit of a mailer, and we've got a few more registrations through SMSF trustees. So we're hoping to get a few more listeners and watchers through that channel as well, as we continue to build the audience now in 2019 and well into 2020. Henry Jennings, thanks so kindly for joining me.
My pleasure.
It's a real pleasure. We appreciate your candor, playing with a very, very straight bat and telling it as it is. And again, we appreciate that commentary ongoing. And for the week 9 of December, we're signing out, and thanks very kindly.